Hi there. Over the last few weeks, my vlogs have been talking about investment options for various periods like short term for 3 years. And in this vlog, which is vlog 30, I'm going to talk about investment periods for investment horizon of 5 years. Welcome to Marin Talks, my vlog where I take you through the steps of investing. If you were to look at a 5 year period, so typically what do you have? You have fixed deposits. Fixed deposits, of course, give you currently about 6%, fully taxable. You have the 5 year tax saving fixed deposit from the post office that also gives you 6% taxable. And then you have the National Savings Certificate or NSC, which gives you currently 6.8%. The problem with NSC is that while it gives you the ADC benefit, the returns from the NSC are fully taxable. And the bigger issue with the NSC really is keeping all those physical certificates. I mean, I really don't know how many people want to keep physical certificates with them at home in this day and age. Remember, with NSC, if you lose the certificate, then you pretty much lose your investment because those certificates can then be encashed by the person who's taken those certificates. I've been talking about mutual funds, and one of the mutual funds that you can consider for a 5 year investment is also short-term debt funds. My last vlog, and I've given the link below, was on short-term debt funds and corporate bond funds, which you can use for periods above 3 years. In the equity category, while I would not recommend pure equity funds because I think, over 5 years returns can be quite volatile. And we are seeing that right now as well, right? I mean, we are seeing that the 5 year returns are pretty low at this point in time. But I think in the 5 year category, you can certainly look at the category of balance funds. Now, this was all one category till the time a recategorization happened by SEBI, which was about 2 years back. As the name suggests, a balance fund is a hybrid fund because it has a combination of stocks and bonds. Now, there are different types of hybrid funds that are available. So you have the conservative hybrid fund, which typically has a very low equity allocation between 10 to 25% in equity and between 75 to 90% in bonds. The conservative hybrid fund is really meant for those people who want to add a little bit of an equity allocation to their existing debt portfolio. I somehow don't find this category to give great returns, and I find this category to be a very lifeless category, honestly. And if you still want to add, if you still primarily want to be in debt investments and have some equity exposure, I would still suggest that buy the debt fund separately and buy the equity fund separately. Another fund that is there in the hybrid space is a balanced fund, which has 40 to 60% in equity and the reverse in debt. Again, it's an okay category. The problem with this category and the conservative hybrid category is the fact that both these categories follow debt taxation and not equity taxation. And I find that the hybrid categories work well in cases where you have a higher equity allocation. So one of the funds that is available is the aggressive hybrid fund, which has more than 65% invested in equity and 35% invested in bonds. Of course, this fund follows an equity taxation. You also have dynamic asset allocation funds, which are also known as balanced advantage funds. Now, in these funds, the allocation between debt and equity is changed based on some sort of quantitative formula. So each fund house has a different quantitative formula. There's not that one particular parameter or one formula that each fund house is using. But the good thing about the balanced advantage funds is that it really changes the allocations in a timely way. So when markets are high, then it would reduce the equity allocation. And when markets are low, then it would increase the allocation. And I think, in the 5 to 7 year space, if you are looking at a reasonably aggressive investment, then I think that the aggressive hybrid fund is a really good choice. And within this, I also think that the balanced advantage funds are a great choice in this space because they keep doing the rebalancing between the assets on a regular basis. Of late, you might have seen many multi-asset funds have also come, and I did a couple of videos, and you must have a look at the video that I did on the Nippon India multi-asset fund, because I also talked about how you decide whether you want to get into a multi-asset fund. But very quickly, a multi-asset fund basically invests in different assets like debt, equity, international equity, and gold as well. Now, there are many different multi-asset funds in India, and each one of them has a different strategy in the sense that some of them don't even have international equities. The newer ones do have international equities, but then the proportion of equity changes in each one of the funds. So, for example, Nippon, the one that closed last week, has a fixed 50 to 70% in equity, whereas Motilal, which came out a month before, has a lower allocation to equity. So I'm really not in favor of multi-asset funds because, it's like this curry that you're putting together with a lot of vegetables. So in that sense, maybe like a mixed vegetable curry, it seems like to me. I'm not in favor of them, but even then, if you are considering a multi-asset fund, well, firstly, remember that you need to have a 5-year holding period. And secondly, you choose the fund depending upon the sort of exposure you want to a particular asset class. So if you feel that you want to have higher equity exposure, then you need to look for that multi-asset fund that has a higher exposure to equity. And of course, if you're conservative and you prefer a more balanced allocation, then you need to look at a fund which is equally spread out. The FinSafe tip and my take, I think for a 5 to 7 year period, if you are an aggressive investor, then the balanced advantage fund or the dynamic asset allocation category works well. And if you are more of a conservative investor, of course, you have the fixed return options, but they're not really very tax efficient. So I wouldn't recommend those. You may decide to invest into the multi-asset category, and within this category, choose funds which are equally diversified among different asset classes, not funds which are skewed towards one particular asset class. I hope you find these vlogs useful. Make sure you click on the bell icon to subscribe. Do write in. I'd love to hear your feedback. Cheers.